Google stock has had a rough start of the year in 2025 because of the huge news that the DOJ is actually going after Google and trying to break up Google Chrome from Google. Also, the fear of AI taking over the Google search business has had worries for investors about the future of Google. However, I've decided to go ahead and take a look at Google stock once again. After 2 years ago, I made a video on Google stock where I believe Google will 10x. And I made this video when the stock was at $96 per share, and I had an intrinsic value price of about $140. So I believe back then that it was a good time to buy, and right now Google is my largest position. So we're going to take a look at Google and see if we should be buying more today. With that being said, I'm going to be using my 7-step stock analysis to determine the financial health of Google, and then at the end of this video, I'm going to be determining what price we should pay for Google stock today to get a good return on our investment. The first metric that I'm going to be looking at for Google is the trailing PE ratio, and this shows us the valuation of Google and how much you're going to be paying for $1 of earnings per share. And I want this to be greater than 0, showing that we are profitable. And as we can see here, we have a trailing PE ratio for Google at 20.15. This means for every dollar of earnings per share, you're going to be paying about $20. And the stock market trades at about 25, so this shows that Google is actually a little bit undervalued when compared to the stock market. And looking at the forward PE ratio, this is the same as the PE ratio where it's price divided by the earnings per share. However, this is going to be the future earnings per share expected by analysts. So this is going to be showing us a future snapshot of the valuation of Google. And this is lower than the trailing PE ratio at 19.38, which is a good thing and shows that analysts do expect the earnings per share to increase in the future, and also shows that in the future that Google is looking pretty undervalued. Now taking a look at the revenue growth rate for Google, I want this to be greater than 5% each year. And as we see here, it has been growing at a pretty fast rate, anywhere from 15 to 30%. Although it has been declining slightly in the past few years, it's still growing at about 10 to 15%. So this is growing faster than 5%, showing that the sales of Google is growing over time, and this is another check mark for Google, and it is growing greater than 5%. So this looks good for the sales of Google. Now taking a look at the net income of Google, which is the amount of profit that Google is earning, and we want this to be greater than 5%. And as we can see here, we can see that it is growing greater than 5%. They started at about $6 billion in 2010, and right now they're at almost $111 billion. And Google is actually the largest net profit company in the entire world, which means they're generating the most amount of profit out of any company. So Google is the largest company in this. So that's a good thing for Google, and also they're trading at a pretty cheap valuation for the amount of growth that they are having. Now, one of my favorite things about Google is the share buyback program that they have. And the reason I like this is because if we are buying back shares, that means us investors will own more of the company. Because say that the shares outstanding decrease over time, that means there's going to be less shares for other people to have, which means our shares will automatically become more valuable and mean that we'll actually own a greater percentage of the company. And as we can see here, ever since 2018, they've been buying back shares at a pretty good rate, which I like about Google. Now looking at the balance sheet of Google, we want the total debt to equity ratio less than 50%. And the total debt to equity ratio shows us the amount of debt divided by equity. So if this is less than 50%, that means that Google would have more than double the amount of equity when compared to their debt. And as we can see here, they have a total debt to equity ratio of 8.25%, showing that they have about 12 times more equity than debt. So they have a lot more equity than debt. And also, as we can see here, they have $95 billion in cash, while on the total debt they only have $28 billion. While $28 billion is a lot, for Google this is a very small amount, so they could be paying this debt off right away with the amount of cash that they have. And this is why I really like Google. They have such a good balance sheet, and just everything about the company looks good. Finally, if we take a look at the analyst expectations for the next 5 years and see how fast they're expected to grow at, we can see that analysts expect them to grow at about 14.9% each year. And we wanted this to be greater than 5%, showing that in the future, their earnings are going to be growing. And the reason we want to see how much they're going to be growing in the future is because the reason a stock price goes up is because of the amount of earnings the company earns each year. And if it increases over time, then the stock will most likely increase with it. And right here, we can see that they're expected to grow at almost 15%. So this is a fast growing company with a pretty low valuation, and which is why I really like Google. Finally, I'm going to use my intrinsic value calculator to determine the price I'd be willing to pay for Google. And the first thing I'm going to do is the revenue growth rate. Analysts expected them to grow at about 14 to 15%. I do think that's a little bit too fast because of the worry of AI and potentially lawsuits that are happening with Google and having to potentially break them up because of monopolistic characteristics. I do think that they could grow at about 12% still. I still think that they're going to be a good company growing at a good rate and generating a lot of money. So that's why I think 12% is pretty reasonable. And for the net profit margin, I'm actually going to leave this at 30%. Since in the past year, they were at around 30%. I think that they can stay right here. And I think this is pretty good for Google. And now looking at the terminal PE ratio, also I'm actually going to leave this at 20. Since the stock market trades at about 25, I do think that Google could potentially have a greater PE ratio than the stock market. But I am going to be more conservative, especially with the worry of the future for Google and AI potentially taking over the business. I do think that there's some headwinds for Google in the future. However, I still think this company is definitely worth it. Finally, for the discount rate, I'm going to put 15%. I want a 15% discount rate to ensure a margin of safety when we invest in this company and also to make a good return on our investment. Since the market averages anywhere from 8 to 10%, I want to be making at least more than that. So I'm going to put 15%. And as we can see here, I get a fair value price for Google at $210.81. Meaning if you bought this stock today, I think you could make about a 17% return on your investment. So thank you guys for watching this video. Please hit the subscribe and like button and see ya.